Well, I have been crowing about liquidity, how the Fed is taking 90 to $95 billion each and every month out of the economy. And you could just see how the economy was reacting, was just slowing down, like the brakes were being put on, and the economy was going to roll over into recession. I still think it's heading into recession, but we've had a pretty nice little bounce. And I'm wondering, why have we had such a bounce? Liquidity is the fuel for the economy. And if you don't have any fuel in your car, the car just eventually stalls and it's just over with. And that's what was happening with our economy. But in the last couple of months, we've had a pretty good marketplace. So let's just explore as to why this is. Remember when we were talking with Dr. Nenner, I always ask him, Dr. Nenner, why do you think this is? And he always says, I can't tell you why, I can only tell you what. And my forecast remains the same, that I think we are going to have the second and final peak in my real estate asset class, third quarter of 2023. And third quarter is going to start here pretty quick. So I'm expecting within about 90 days that we're going to peak. And we're going to talk about that. And I think the rest of the economy is going to peak as well. But let's just explore what's going on now, because it's really pretty interesting. So let me go to my very next slide here, and let's just take a look at this. So what happens when you add liquidity to the economy? It's like throwing gasoline on a fire. It's like filling up your car with fuel and with rocket fuel. And this is what happened. We've had the Federal Reserve put almost $400 billion into the economy in 1 week. Now, it takes a little while for this to filter through the economy, but it does certainly get there. And it goes into certain asset classes really quick. It goes into the stock market almost immediately. So we can see that. So let's just talk about what's going on here. So in April, we were talking about this. We were talking about the fact that the year-over-year money supply growth was at a negative 12%. Well, I have to tell you, in April, our money supply figures were just off the chart. I mean, if you can see this, you can see how this had declined. It was like a historic. It had never happened before. And, ever is a pretty doggone long time. So, and that was certainly reacting into my asset class. We could see that the home sales had declined, the worst drop of since COVID, the worst since 2007. I mean, you can see how badly the real estate segment had dropped, and we were just heading into some really, really tough times. So let me just take a look at this. And home prices in Seattle, San Diego, and San Francisco, which I talk about all the time because they're so easy to talk about, they were declining, and they were year over year, they're underwater. San Francisco, of course, was down like 12, 13, 14%. I've seen some as 17%. We've seen some places that are really, really dramatic and drastic. So, I mean, if you bought a $2 million house, which is typical, you had at least a 2 or 2.2 million, I think was the actual figure in San Francisco, and you have a drop 15%, well, you've lost $300,000 on your property. A lot of people didn't put that much down. If you put 5% down, you've lost 3 times your down payment in less than a year. So that's what was happening, and that was in April of this year. Let me go to my very next slide here. And what happened in the stock market? Now, the stock market really feels liquidity really, really quickly. So March 13th of 2023, the Dow stood at 31,800. And here we are today, June 27th, it's up 2,100 points. And what is that? That's like 75 days. It's come up 2,000 points in 75 days. Wow. That is a lot. That is pretty doggone what that would say. That was a very, very good bounce in the economy from that, or bounce in the stock market. And look what happened in my real estate market. Now, according to CoreLogic, on their adjusted basis, we had a huge pop. April and May, homes just surged. We had tremendous sales. We had prices go up, and it was one of the biggest months they've ever had. Now, before that, they had really just, you can see this red declines here, and this was what we were talking about going forward. It was pretty terrible in the last couple of months. They got a pretty big pop. So let's talk about that, because my timing model says we're at the end of the cycle. We are end of the road. We are going to finish up. We're going to complete. And on the completion side, that's when we have some pretty terrible corrections. It's a really bad time sometimes to be an investor. And right after that becomes a great time. So once the cycle is completed and we get this drop, and wherever it's going to correct to, we want to buy. That's our target. We want to get right down there where it starts to level off. It doesn't have to get to the bottom for us. I'm going to tell you that right now, because this is where most of the really, really good properties that have been sitting there accumulate, and we can buy some really, really outstanding properties. Now, I'm going to tell you, when we're doing the calculations itself, we're showing you the stylized version. Textbook says there's 2 peaks. So the first peak is in, and that came in Phoenix in March of 2022. And that is where you have all the people that are overbidding. They're so excited. They want to buy. They're talking to their friends at the cocktail parties and out to dinner, and they're playing golf. They're saying all the houses that they bought and how well they're doing on their investments. That's FOMO, fear of missing out. It's just crazy at that time. That ended March of 2022. And what will happen? You get a correction. Textbook is about 11%. Could go to 12, but typically 11. Now, Phoenix came down 10.6%, if you can believe that, almost perfect. And then you get the second pop. That's the second peak, and that will recover 5, 6, 7%. Now, when you talk to Dr. Nenner, again, Dr. Nenner never tells you why. He'll tell you what. And this is just what our cycle predicts. It just tells you what is going to happen, doesn't tell you why. So today we're going to talk a little bit about why this is happening. So let's just take a look, and here it is. It's no secret. March 8th, the Federal Reserve added liquidity, and they added it in a big way. They went over $300 billion in 1 week. $300 billion of fresh liquidity in 1 week. And here we go. If we go into the Federal Reserve electronic data, you can absolutely see it. You can see where that was rounding and peaked. They're taking out gradual removal of liquidity. And then March 8th, you can actually see the date. March 8th, they added $391 billion in fresh liquidity. And of course, if you look back, you can see this because Silicon Valley was there. It was collapsing. Signature Bank was collapsing. A Republic Bank was collapsing. And of course, Credit Suisse. And they added liquidity, and it went right into the marketplaces. Now, it takes a little longer to get into the real estate asset place than it does to get into the Dow Jones. But the Dow, you can see it. It popped. Now, the question is, how long is this pop good for? So we think it's only good till the third quarter. Nothing has changed on nothing has changed on my target market, my model. Not a thing has, my timing model has not changed 1 iota. We still think that the peak. Now, when you say the peak, that means that that's the end of the price increases, that they'll gradually start to roll over, and then maybe we get a little rush, maybe a little waterfall. But I don't think that we have a date in third quarter where all of a sudden things are just going to collapse. That's not what's going to happen. They're just going to quit going up. That means appreciation is over. And I think that is probably third quarter of this year. I see nothing that's going to dissuade me from thinking that. And I think we have the second peak is forming now. So let me just go to these others. So here's what happens when you take liquidity out. The PPI is dropping. So I think we're going to have a little bit of a respite from inflation. Now, we're going to be doing some more research. I don't want to deflect from this one, but we think that the U.S. dollar is under attack and that the U.S. dollar will probably decline. And if the U.S. dollar declines, that means we're going to be importing inflation into our economy, and we're going to have inflation in an outlying time frame. But at the moment, we can see that the PPI, the Producer Price Index, is dropping right along with the liquidity drain. Now, we just had a little bit of pop in liquidity, so I expect that the PPI will pop up a little bit. But I think this is just a bounce. I don't see this as a major inflection, because the addition to the liquidity is over with. So in April, we were down negative 12% on money supply, the greatest since the Great Depression. So we were really heading into a really, really bad system. So the Federal Reserve decided they wanted to save the banking system. So they added liquidity. That's the only reason it happened. And of course, it takes a little while to filter through, and that filter through is right now. We're starting to feel that. So we're seeing that new homes popped up 12.2% in May. That's a huge. Now the builders are in risk. They've got all these houses that they're building for buyers, and the buyers have gone from like a 3% mortgage, 3.5% mortgage when they signed on. A year later, a year and a half, because it's taking forever for these properties to get built, and all of a sudden their house payments go up $1,000 or $1,500. They go from like 3.5% to 7%. 6.5% to 7.5%, somewhere in that range. Whatever it is, it's a lot higher than it was when they originally bought. And a lot of these homes are being completed, and the buyers can't afford them, so they come back as specs. So the builders are just scared to death. They want to get rid of these properties, so they're doing everything they possibly can. They're making deals. They're buying rates down. They're giving you incentives like galore to buy their properties. But we've gotten this pop. You can see it. I don't think it's going to last for too terribly long. So when you start looking at this, I think this gives us as really, really good. Now this is coming here, so we want you to see that here's the peak in March of 2022, and I think right where that red arrow is, that's the second peak that's forming. That is the last peak. So when you get to the last peak, that's telling you if you need to sell, you need to do it now. Now, if you're going to buy, I think you got a much better buying opportunity coming. So if you're a first-time home buyer, I've got some pretty good news for you. I think that you're going to get much lower prices in, a year from now are going to be a whole lot better. So if you can wait to a year and, add to your down payment, get your credit scores up higher, stabilize your job, try and get rid of some of your bills. This is just going to be a great opportunity for you to pick up some houses, and you're going to pick them up at probably a pretty good price. But if you got to sell into that, it's not a good time. It's going to be a great time to buy. If it's a good time to buy means it's a terrible time to sell. So you need to do that now. So if you're going to hold a property, you need to hold that for 4 or 5 years. So you just need to talk to your financial advisor, talk to your brokers. If you want to talk to us, we certainly can. But this is a decision that you're going to have to make. So if you decide to keep it, you're keeping it for 5 years. So if you need to sell, you need to sell now. So talk to your brokers and make that decision for you. We're more than happy to be involved with that, but that is a decision you have to make. So this is a courtesy of John Woke here in Phoenix. He's done some great jobs with keeping track of statistics for us. And I'm going to tell you, for Phoenix, you can just see clear as a bell. First peak is March 2022, and again, I think we have evidence right here. You can start seeing that second peak. Now, we could come up a little bit. I doubt that we're going to go as high as the very first peak. I doubt that we're going to do it. Nothing technically says we can't. I just think we're getting a little long in the tooth. If that was going to happen, it should be happening now. I don't see that happening. And I think this is a second peak forming. And just like over here, when you started to get this in 2006 through 2008, you had a couple of peaks, and then it's rolled over, and I think that's what's going to happen. Now, here in Phoenix, Arizona, I don't think it's going to be as severe as the rest of the nation, but I do think it's going to be pretty severe. I don't see us in Phoenix, Metro Phoenix, being immune to this, but I think around the country, if you're in some of the endangered cities, if you're in Boise, Idaho, or Chicago, or Milwaukee and Minneapolis, Portland, Oregon, I think that you could see declines of 30 to 65%, particularly if you start seeing an aggressive Fed. Now, the Fed said that they were pausing for a moment. I think they did that because they wanted to make sure that they stabilized the banking industry, but they didn't say they were going to stop. They're talking about another increase in July and maybe one in September. I believe them. I think, and we have not felt all the effects of these rate increases. So I think the economy is going to slow. And I think that what you're experiencing right now is just a bounce. I think it's strictly from the liquidity. It fits perfectly into our model. It's the why to our what's going to happen. So I think that you need to take advantage of it right now. If you do have a property to sell, I think now's the time to do that. Let me just go on the next slide. So if you're in any of these cities, I keep beating a drum on this, but if you're in Chicago or Milwaukee or Minneapolis, here's what you have. There's only one word you've got to really just keep in your forefront is why. Why are you there? If you are an investor, you can invest anywhere in the country. You can go to Florida, you can go to Texas, you can go to Arizona. You can go to any of these places that have bright futures, and you can move your investments. That's called a 1031 exchange. It's a 1031 deferred exchange. It means you're deferring the taxes. And of course, that's very, very good business. So you can get out of a kind of an iffy market and get into a much better market. You can go to Plano, Texas. You can go to Miami or Tampa, Florida. You can come here to Metro Phoenix, where things are really, really good. I mean, we have such great business opportunities here, and you don't get a taxable event. We defer that. So talk to your brokers if this is something that you want to do. I'm more than happy to make ourselves available for you. We certainly have good properties if you want to exchange. We'll certainly, if you want, that's called it would be the replacement property. So you have a relinquished property in one of these bad markets. I mean, if you're in Philadelphia, you have to ask yourself, why am I in Philadelphia? So what you don't see on my endangered list is Detroit, and you don't see Baltimore, because those cities have already failed. Now, those cities, the investors lost 60, 70, 80%, 90%. Some people just let them go. The places just lost all kinds of business. We've done videos on Baltimore. This is just terrible. So lots of problems. If you're in a city that you're having a problem, you don't need to stay there. You can get yourself out of there and improve your life. So this is how you can find me. You can call me. You can certainly get hold of me. We'll certainly talk to you and do anything we possibly can to advise you. We have a very, very good team here. If I can help in any way, just give us a call. My best. Bye-bye.